Welcome back to the stream. I am JC Peretz of allstarcharts.com, and I thought we'd take some time, a few minutes, to talk about a few of the charts that we have on our radar. I think the first one kind of really tells a really interesting story as to really the past year. So we're looking at the last 12 months of performance. Obviously, base metals, maybe not obvious, but I just can't reiterate enough just how strong base metals have been, not just copper, as you can see here, up over 50% over the last year, but steel and iron ore and just aluminum, zinc, tin, lead, just a ton of strength there, outperforming commodities in general, which have really been the leaders over the past year, and then some, really since crude oil traded below zero last April. It's really been a ripper ever since. Obviously, stocks have done well, particularly the large caps. So here we're looking at the S&P up over 32%. The ACWI All Country World Index, this is outside of the United States, up 26%. And then emerging markets, obviously been struggling since February, still up over 20% over the last year. The real losers, the worst possible investments you could have had over the last year has been in precious metals. I mean, you could have literally bought anything else, and it would have been a better idea than buying gold or even silver. And just showing, really we ran into those former levels from 2011. From 10 years ago, we ran into those levels and we retreated, right? There's still an overwhelming amount of supply of gold relative to demand. And here you can see it in the GLD ETF, just, classic resistance. And now relative to the S&P 500, we're making 16-year lows, right? So really the all-time lowest levels in gold in the GLD ETF relative to the NASDAQ 100, 16-year lows relative to the SPY. And then really from any sort of structural perspective, we're stuck below all this overhead supply. So we're going to look at Cardano in a minute, and where has Cardano been struggling? It's been struggling at the former highs. In that case, in 2018. In this case, we're talking about gold 2011, but same principle, struggling below overhead supply. And you can see what Cardano has done over the last couple of weeks. And now we have a clean level to trade against, which are those former highs from the previous cycle peak, which was right around $1.40 in the Cardano. Actually, since we're on the subject, let me just show you. So this is what I mean. Cardano. So we're looking at the former highs in 2018. We ran into those levels and it's really been a struggle. We had a false start earlier this year, but if we're above $1.40 in Cardano, I think you gotta be long. That completes that. So getting back to the gold situation, same exact thing, right? We want to own gold if we're above those former highs. In the meantime, it's a mess. Listen, it was a great trade buying that weakness, particularly GDX. It was working in our favor for a while, and now it's really become a dud, and it's range bound at best. So, listen, if you have a long-term view in gold, I think you could be patient, right? If you have a shorter-term view in gold and you want to buy some oversold conditions and things like that, that's totally up to you. But just the fact of the matter is there's still an overwhelming amount of supply relative to demand, and precious metals have a lot of work to do. Look at silver, resolving this consolidation to the downside. This is as textbook and classic of a continuation pattern as they get, and it is resolving to the downside. And as we have made, I'm very clear about this. And I mean, if you're going to take anything from this live stream at all, is just understand this. When the market is supposed to do something and it does the opposite, there's wisdom there. There's real information there. Look at the TLT in the summer of 2012, for example. I don't have the chart with me, but for you guys, pull it up and you'll see a continuation pattern resolving lower and rates rip from there. It was a fantastic signal. What are we seeing here in silver? We're seeing a continuation pattern that should be resolving in the direction of the underlying trend, which is up, resolving lower. So further pressure and even more work to do for precious metals. And the stronger dollar obviously hasn't helped the situation. US dollar index making new 4-month highs on the blog. Check it out. What we're seeing is, what we're calling kind of like a stealth divergence, because the euro's been getting slaughtered and the euro's a huge percentage of the dollar index. But in a lot of other currencies, we're not seeing that strength in the US dollar. So there's a really interesting bifurcation between the two, in a similar situation to the stock market, where you have winners, a few winners, and mostly losers, or mostly duds for the most part. It's interesting, the dynamic. We're writing about it today, so check that out on the blog. And then here you could see, I've been saying the stock market peaked in February, and I laugh because I always get like a lot of like pushback from that. It's like, listen, the data speaks for itself. February was the best things were in this cycle. And since then, it just hasn't been as good as that. In fact, it's gotten progressively worse ever since. You can see here a bunch of important areas. The IPO index peaked in February. Small cap stopped going up. Emerging markets peaked in February. Biotech peaked in February. The NASDAQ advanced decline line peaked in February. The new highs list peaked in February. So it doesn't mean that some stocks haven't done well. In fact, some have, and particularly some of the biggest ones that are driving some of the major indexes like the S&P and the NASDAQ. And it's really been hiding it's been hiding most of the weakness taking place underneath the surface. One for the bulls, most definitely. This has changed this week, but just finishing out last week at new multi-decade lows. These are the lowest in 20 years in consumer staples on a relative basis, which is consistent with an environment that stocks should be doing well, right? So it's not a bad signal. So look for that reversal. And if we start to see relative strength in staples, that should coincide with continued messy environment for most stocks. And it's really, when you talk about the cap scale, the biggest and the baddest are the ones that, have really been driving these major indexes. And you can see it in the NASDAQ 100. So the NASDAQ 100 are the biggest 100 essentially, and the NASDAQ, the QQQJ are the next 100. So essentially 101 through 200, if you will. And you can see that particular index is still stuck below those February highs. Speaking of things that peaked in February, the NASDAQ peaked in February, so this shouldn't be a surprise, but just another one to add to the list. The NASDAQ next 100 peaking in February and really flat, actually down since then. And then when you compare the QQQJ relative to the NASDAQ 100, so in other words, 101 through 200 relative to the top 100, you're down near all-time lows since this thing was launched last fall. And it just showed, you could really see it on the absolute price too, but the relative strength ratio really tells that story. So just a lot of names stuck below overhead supply. Not anything new. Look at Palo Alto, stuck below those former highs from February. Look at Pfizer. The joke was that Pfizer's still been battling with these levels since I was in high school. These were the highs in the late 90s. JC was not even, I had no clue what the stock market was, which is hilarious. And we're still stuck below that overhead supply. By the way, if you're interested in these slides, email info@allstarcharts.com. So info@allstarcharts.com, and make sure to use the password Summer Doldrums. If you don't use the password, who knows what deck you're going to get. I give a lot of presentations for different conferences and different societies and whatnot around the world. So if you want to make sure to get this one, make sure to use the password Summer Doldrums. All right. A friend of mine, I've known for a while, smart guy, looks at a lot of markets, is asking about TAN. And I'm just like, man, if somebody wants to ask me what a messy market looks like, I'm going to send them this. I mean, just nasty, just stuck in this range, obviously, right near a flat 200-day moving average. Listen, if you like headaches, trade stocks near flat 200 days. I mean, man, you are signing up for some serious pain, just a lot of frustration mostly. I know that from experience. I have a lot of post-traumatic stress disorder from being in positions that looked like this, near flat 200-day moving averages, not trending. No bueno. It's not fun. So, needless to say, momentum getting oversold and overbought. Like, momentum can't figure out what side it wants to be on, near flat 200-day. I mean, this has headache written all over it. It could break out. It could break down. Chances are, whichever one it does, it probably mean reverts and doesn't even start a new trend. That's what you're begging for. So if you're bearish, you're probably going to get whipsawed. If you're bullish, you're probably going to get whipsawed, right? Like, it's just, for me, it's not worth it. No thanks. So this was an interesting one. DRIV. So DRIV is the Autonomous and Electric Vehicles ETF. You're going to get a lot of tech, a lot of growth. So you could see the struggle really since February when the NASDAQ peaked. So it makes sense. You're seeing a very similar story, right? So you ran into those former highs right before COVID, never were able to break out, complete collapse during COVID, came back. One of the early ones, I remember vividly some of these names really early on in the breakouts showing relative strength, right? Think about how many stocks are still below their 2018 highs or their COVID highs, or usually both. This was one of the first ones to break out above that. But needless to say, have been consolidating above a key Fibonacci extension level, which to me is definitely the more bullish of the two. Would you rather see a consolidation where the Fibonacci extensions are support, or would you rather be below that extension and it's serving as resistance? If you ask me, I think as support, Definitely. So if we're above 26 and a quarter, I think you could be long, but I really, really want to be long if we're above the February highs, right? Like so many other things, right? If small caps are able to get above those February highs, emerging markets, biotech, those February highs, just as a reminder, a lot of things peaked, right? A lot. And, you know, when I say the stock market peaked, maybe that's a generalization too much, but to put it in simpler terms, February was the best things were. And I think we could all probably agree with that. Remember, those all the SPACs were breaking out and all that stuff. So also in the crypto, just absolutely ripping, like really ripping. And it's like Biff Tannen in Back to the Future. Like there's something very familiar about all this. I remember vividly in 2010, classic head and shoulders top in the S&P 500. A lot of journalists in the media were calling it out. Oh, that's it, broke. And then we obviously, that's exactly what it wasn't. And we ripped. And then same exact thing what we saw in crypto. You know, in Bitcoin, a lot of like head and shoulders tops, particularly from members of the media that are not technicians, they're journalists. And they're chiming in on the head and shoulders pattern. Man, it's like deja vu all over again, to quote the great Yogi Berra. And man, it just looks awfully familiar. So obviously, you know, the trade has been, you know, be long in Bitcoin if we're above 30,000. That's clearly been working. You know, that could potentially see 100,000 in Bitcoin. And then the Cardano, the trade has been, you know, as we mentioned before, be long if we're above those 2018 highs, right? Same thing in gold. We want to be long if we're above the 2011 highs. In the meantime, it's a headache. Obviously, do you know any happy gold bugs? Seriously, do you know any happy gold bugs? I know zero, right? So Cardano, same thing. We only want to be long if we're above that. And by the way, we are above that, right? So that's a name we definitely want to be long. Not to mention on a relative basis, when you look at Cardano relative to Bitcoin, you know, key Fibonacci extension level, former resistance earlier this year, you know, just clean. If Cardano's going to outperform ever, this would be a perfectly logical place for it to do so. And that is precisely what we've been seeing in recent days. You know, if you're not trading cryptocurrencies, but looking for exposure, you know, I think this Silvergate is really interesting. It's a $3 billion stock. It's a regional bank out of La Jolla down in Southern California. So a little, you know, which will forever hold a special place in my heart. That San Diego, La Jolla area, even Laguna. Oh, it's my favorite. So anyway, Silvergate based right out of there, $3 billion mid-cap regional bank. They're doing a lot of stuff in the fintech space and in crypto and stuff like that. I'm not going to, I try to stay in my own lane, but that's the sitch. It keeps coming up in all our like crypto-related stock scans. So we just group it in with a series of others like Coinbase and, you know, even Robinhood we've added recently, you know, MicroStrategy and some of the others, right? Tesla, right? So Silvergate, to me, that's a big one. So we're looking at SI, and I really like mid caps. This thing could triple, and it's still not even a large cap, right? Just think about that. So there's a lot of, you know, for me, there's a lot of alpha in these names. I'm looking at about $1.20, hovering right there. If we're not above $1.20, I think there's probably too much trouble. Above $1.20, I like this one long, and I think we can get back to those former highs right around 175 or so. That's what it looks like to me. Back to those former highs and then some, right? 300, 400, why not, right? That's how this thing is set up, certainly in the right space where, you know, we're not looking at traditional bank growth, but if it's lumped in with the crypto money, you know, who knows how high it can go. It can go really, really high. And that's really a theme that we've been seeing. If that's a bottom of interest rates, and that was it, if we can get above 1.4, where are we? We are right below 1.4. That's a big level. The U.S. 10-year yield can get above that. I'll be really, really impressed. I think it'll be great for regional banks. So now what you're seeing in the SI, you're getting crypto breaking out. You're getting regional bank sympathy bid with higher interest rates. So, you know, it's a great example of really tying markets together to increase our probability, right? Our chances of being correct, not to mention the risk reward is very favorable as we only want to be long the SI if we're above $1.20. If not, we leave it alone. So the risk reward very much skewed in favor of the bulls, not to mention the macro seems to be adding up, especially if 10s can get back above 1.4%. And is that what copper and gold are telling us? We talked about the, you know, just the lack of bid in gold. Like nobody wants your rocks, bro, right? Like nobody. So what does that mean as base metals continue to get that bid? So on a relative basis, the strength in base metals with the destruction in gold screams higher interest rates, right? Screams higher rates. These lines look the same. If this ratio is going up, that means copper's outperforming gold. That means rates are going higher. That's how I see it. So I think it's really, really interesting dynamic that really, I mean, do yourselves a favor. Do yourselves a favor. Everybody listening out here, go to your favorite scan or screener, FinViz or CoiFin or whatever it is you do, and go to regional and community banks that are bigger than $2 billion in market cap and sort them by performance of year to date. Simple. And go chart by chart by chart. I'm telling you from the bottom of my heart, you'll thank me. You're going to find some great names there. 2 billion and above, I think, is probably a pretty good sweet spot. And if rates are ripping above 1.4%, and it certainly looks like the copper gold ratio, that's what it's pointing to, you know, I think those are going to be the biggest winners. And if you can see financials, particularly the XLF, above 38 and a quarter, which it currently is as I'm recording this, the market's closed for the day Tuesday, and we did close above that. If we're above those former highs from May in financials, and rates are above 1.4%, we got to be obnoxiously long some of these leading regional banks, in my opinion. And that's what it looks like to me. So if you're interested in the slides, once again, email info@allstarcharts.com. And make sure to use the password Summer Doldrums. And folks, those are the charts that I have on my radar. If you find it interesting or you have any questions, shoot me a note, info@allstarcharts.com. Make sure to say what's up at All-Star Charts on Twitter, StockTwits, Instagram, YouTube, and Clubhouse. Thanks, guys.